Well, my friends, there is disaster in the retail sector. The last 2 Walmart locations in Portland are permanently shutting their doors on Friday. The closures, which were announced in late February, mean nearly 600 employees are being laid off. You have probably already heard that Kohl's has been in trouble for a while now. And that management has been trying to sell the company. And that, so far, no reasonable offers have been received. So, the company continues to operate independently. Well, we all know what normally happens to public companies whose financial performance degrades or languishes for long periods of time. You guessed it, activist shareholders come along and push for big changes. Similarly, Bed Bath & Beyond is heading into what might be its last holiday season. Saddled with huge debt on its balance sheet and an unimpressive product lineup, financial disaster appears to be on the horizon. What does all of this mean for the retail industry? What does this mean for the US economy? And what does this mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified when new videos are released. A retail ice age is a term used to describe the multitudes of stores that are closing lately due to inflation, shoppers' habits shifting to e-commerce, and more. Retail expert warns malls will see ice age and Darwinian destruction if they don't reinvent themselves. Walmart will close its last 2 stores in crime-plagued Portland, Oregon. Portland is contending with a relentless wave of shoplifting that has hammered retailers. The retail ice age is a term used to describe the current state of disruption and transformation in the retail industry. It refers to the challenges faced by traditional brick-and-mortar retailers who are struggling to adapt to changing consumer behaviors, increasing competition from e-commerce companies, and shifting market dynamics. The term ice age is used to describe this phenomenon because it suggests a time of frozen stasis, where the old ways of doing things are no longer effective, and retailers are facing significant difficulties in adapting to the new reality of the market. The retail ice age is characterized by a number of trends, including the growth of e-commerce, the rise of mobile shopping, and the increasing importance of data-driven personalization and customization. Retailers who fail to adapt to these new realities risk being left behind, as consumers continue to shift their purchasing habits online and demand more personalized and convenient shopping experiences. However, those who are able to adapt and innovate are likely to emerge stronger, as they find new ways to engage with consumers and meet their evolving needs. Since the start of 2023, several beloved brands like Party City and Tuesday Morning have filed for Chapter 11 bankruptcy protection. Chapter 11 bankruptcy typically allows a business to keep trading while it restructures its debts. Many retailers are impacted by this so-called retail apocalypse. The Fed rate hikes have slowly started to reduce inflation, yet prices remain high. Unemployment figures persist at record lows, despite many large employers cutting back. Continuing supply chain issues persist as China reopens in the face of its COVID crisis. And consumer spending is tightening in preparation for bumps in the year ahead. This volatile mix of economic data may lead several retailers to use the bankruptcy process to stay viable. The following retailers are at risk of a possible Chapter 11 filing. Bed Bath & Beyond. Is it beyond saving? Several of the company's key suppliers and smaller vendors stopped shipping to the company or were not accepting new orders. In addition, can the retailer of home goods and college furnishings survive with the looming education cliff, which is where college enrollments are expected to contract significantly? Jo-Ann Fabrics, now formerly known as Jo-Ann, faces declining sales, comps, margins, and increasing costs, creating an uphill battle for the crafts retailer. Sales were $562.8 million, almost an 8% decline, and that to improve its liquidity and balance sheet, the company said it is suspending its quarterly dividend. Can the retailer survive without filing for Chapter 11? AMC. Rumors persist that first and second lien holders are working with restructuring advisors. Further, allegations continue that Sam Bankman-Fried's FTX may have manipulated AMC stock. Yet, the company is issuing a co-branded Visa card next year to boost revenue. But, how long can the chain last before having to significantly restructure? Dollar General. Actually, many middle and high-income shoppers are now going to the retailer, which is good news. But, like Bed Bath & Beyond, the retailer is closing stores. Will all the newly opened stores pre-COVID cause Dollar General to use bankruptcy to reduce its footprint in the new year due to labor shortages and supply chain issues? Mattress Firm. Previously, Mattress Firm emerged from Chapter 11 in 2018 with a reduced footprint. However, bedding demand is in decline as consumers cut spending. Further, Serta Simmons Bedding, a major mattress manufacturer, is planning to file for bankruptcy in January 2023. Rite Aid. This Philadelphia-based company had three major red flags, which persist to date: deteriorating financing, inability to deleverage, and rock bottom valuation. Fitch Ratings downgraded Rite Aid's long-term issuer default rating to C from B. Higher costs related to its plan to close stores, rising pressure on consumer spending, and supply chain concerns do not bode well for Rite Aid. The Gap. Despite the rosy sales figures last quarter, there is much concern that supply chain issues and expected lower consumer spending could severely affect sales in the first part of the new year. If this occurs, how long can the retailer last before it considers a bankruptcy filing? Kohl's, one of the last department stores. During the company's third-quarter earnings call, sales decelerated in October and early November compared to the year prior. Thin margins with inflation and a decline in discretionary spending are squeezing the company and could lead to a bankruptcy filing. We have all seen this movie before. Public company falls on hard times and things do not seem to be getting any better despite high-profile management initiatives. So, enter an activist shareholder and things get interesting from there. In the case of Kohl's, activist investor Ancora Holdings has entered the picture and is pushing the board to fire Kohl's CEO and chairman. Michelle Gass has been the CEO of Kohl's since 2018. Peter Boneparth became Kohl's chairman this year. This is not the first time that Ancora Holdings has pushed to restructure Kohl's board. The activist shareholder expressed its demands in a letter to the board on Thursday. Ancora has only a 2.5% stake in Kohl's. But activist shareholders typically curry favor and support from other institutional shareholders, most of whom hold much larger stakes. Ancora is demanding new leadership so that Kohl's can revamp its business. Kohl's needs new leadership with demonstrated experience in cost containment, margin expansion, product catalog optimization and, most importantly, turnarounds, said Ancora in the letter. Kohl's tried to sell the entire company to Franchise Group. But talks stalled and were eventually terminated because a deal could not be struck. The company had been encouraged by activist investors to pursue a sale. Franchise Group made an original proposal to buy Kohl's for $60 per share. Then macroeconomic conditions deteriorated and the bid was reduced to $53 per share. Kohl's declined the offer and talks were ended. CEO Michelle Gass took over as CEO for Kevin Mansell 4 years ago. She was previously an executive at Starbucks. She brought expansion plans, including the more Sephora mini-stores within Kohl's stores. The Ancora letter referred to Gass as a talented leader, and actually endorsed the Sephora partnership. Peter Boneparth became Kohl's chairman in 2022 but has been a director at Kohl's since 2008. During the Boneparth era, the board has created an environment in which Ms. Gass is no longer well-positioned to lead, the Ancora letter said. Ancora Holdings tried to take control of Kohl's board in 2021. At that time, Ancora and other shareholders demanded new directors with retail experience. They also demanded inventory reduction and the sale of real estate owned by Kohl's. Kohl's board resisted the demand and the sides settled by adding 3 new directors. Oak Street Real Estate Capital made a bid for real estate held by Kohl's earlier in September. Oak Street offered $2 billion for all of Kohl's real estate. If the deal were to go through, Kohl's would have to lease back its store locations. Now you've got an environment where financing has changed so much that it may in fact be more attractive to use real estate as a monetization vehicle, board chairman Boneparth said. Neither Kohl's nor Ancora Holdings responded to requests for comment. Of course, Kohl's is not the only struggling retailer these days. Bed Bath & Beyond is in serious trouble. The company is hoping that a major change in strategy will help it to survive. The plan is for the company to transition its inventory to more well-recognized brands. Wall Street analysts think that the upcoming holiday season will determine whether the company survives. Bed Bath & Beyond has a ton of debt on its weak balance sheet. It is working through issues related to a leadership transition. A bad holiday season could worsen Bed Bath's already declining sales and force the company into bankruptcy. Retail stores need hot items on the shelves when customers want them. As previously shared, we are committed to delivering what our customers want, driving growth and profitability, and strengthening our financial position, said the company in a prepared statement. We recognize the vital importance of our supplier partners and our team is working continuously with them as partners, the statement continued. They want us to win, by supporting the assortment changes previously announced to create the best experience for our shared customers, the statement also noted. The deteriorating macroeconomic environment has intensified the problems. But, what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified when new videos are released. Please share this video on social media. Thank you for watching.